Hello viewers, my name is Saurabh Atwa and this is my channel Tax Accountant, where I like to cover basic details about accounting and taxation and help all the people like you to understand the concept better. So today I'm going to cover the video on income tax. Seems very big topic, but I would like to comply and explain in a very simple terms what is income tax. So income tax, as we know, income tax is a tax on the income. The government want some tax from what you earn, and this is how income tax is calculated. Now understand the history of income tax. It used to be, this is when I was reading taxation back in university, it used to be the Windows tax. So Windows tax means some civilization had how they find people are rich. So depending on how many windows they have in their houses, so more windows that you have, of course you are better off and you got a better house, so you pay more tax. So and then they said, okay, land tax, depending on number of units of land that you own, you will pay tax based on that, because this is how rich you are. This is what they can count the windows, they can count the land, they can tax you, but they can't count other things, so they couldn't tax you. So we have come a long way from what it used to be to now. Now everything's digital and things are coming into bank accounts and stuff, so it's easier for the tax authorities to count how much is your income. So they generally allow you to put your tax return first. So put your tax return, which is a self-assessment tax system. Once you put your tax return, then they will know how much tax you're paying. Then they will have some comparative tools, depending on what industry or sector you are in, how much tax that you have put in versus how much tax other people have put in, and based on that they will know, oh, this person is not paying fair share of tax, let's go and audit that person. So this is how they do it. So in New Zealand also, we had earlier in 70s, prior to introduction of GST, so GST was introduced in 1985, and prior to that the tax rate was 67%. So 67% was income tax rate. Can you believe it? Not long ago, just before the introduction of GST. Now what happened is there was no incentive for people to work. They say, oh, if I get promoted, which is the highest tax rate, if I earn over that level of income, then I'll have to pay tax. No, I don't want to work. So there was no incentive for people to work, and we were discouraging people to work extra and earn more money. And reliance on income tax was too big. So they came up with this idea of, let's lower the rate but introduce another rate, which is tax, which is a GST. So today, so from there, I think PAYE is a very large portion. Another big portion is the GST, and income tax is a very small portion. I don't put in the exact things, but understand the concept. PAYE and GST are the largest contributor for the tax collection. Income tax is just a bit of it, not too much. But if you think about it, income tax is a big thing, because PAYE is a pay as you earn model, is also income tax. So as you can see, GST is still quite a bit portion the government collect its taxes. Now how different entities are taxed. So different entities being our personal. So if you're a personal income, more likely you will be taxed at source. So you don't need to worry about it. Tax will be taken off from you. Just remember one thing: it's a marginal tax rate. If you earn more money, you pay more. If you earn less money, you pay less. But if you earn more than 180, 39% is the highest tax rate we have as of today, and less than $14,000 is only 10.5. In the middle, on an average, I think you will pay around 25% tax. Exact numbers you will find it, but I'm just trying to explain you the concept here. So you always pay tax on net income. Now I just explain you how the whole tax things work so that you understand that part. Okay, let's say you are a company. Okay, and you earn sales of $10,000. Now all these numbers are excluding GST, ex GST. There is no GST here. Okay. Now all the expenses. Okay, to drive the sales, I have to spend my vehicle. I have to use my vehicle. I have to pay my salary to workers, rent, entertainment, office, all these expenses I have to do. I spend about $8,000. So income is 2,000. So I will pay tax on the 2,000. This is my taxable income. Because it's a company, my tax rate will be 28%, and 28% of that will be 280 plus 280, 560. So 560 will be my tax bill, which I will pay. It's as simple as that. Okay, so the next part is your tax return, provisional tax, and overseas income. I'll try to cover all together. Now tax returns, that you can do online, or get people like us to help you to put a tax return. So there are various kinds of tax returns, which is IR3. Now this is, I'm talking about from New Zealand perspective, but in whichever country you are in, there will be some kind of different name, but concept going to be very similar. So this is a personal tax return, and this is a company tax return, trust, partnership, like that. You will have different kind of tax returns. Now, when you put your tax return, it will have, understand two basic concept, right? There are many things, there's two basic concept. How much I'm paying and how much I'm getting refund. So this is a terminal tax, right? Terminal tax. So whether I have to pay tax or I'm getting a refund, right? Pay or refund. Just look at these two things. And second most important thing, you look at provisional. The provisional tax is it says it's a provisional tax. We don't know the exact number. We're just doing a provision for the next year. So we just pay next year in advance. Just that's all. Provisional next year in advance, which we don't know the exact number yet, but we are trying to pay it over there. Now, when you pay the tax, then you will get some tax credit. So this is how your tax return look. So in your tax return, various kinds of income come together and various kinds of taxes come together. It's a consolidated statement of what happened throughout the year. So if you're an individual, so you might have different income. You might have a salary here, plus rental income, plus dividend, plus interest, plus self-employment income, gain on sale. So let's say this is 100,000, 10,000, 10,000, 10, 10, 10, 30, 50. So total income is 150,000. On that there will be some tax paid at source. So salary is PAYE, already paid. T. Let's say your tax bill comes out to be 40,000. So that's your tax bill. But you might have some tax credits here. So 25,000. This is example. Is your PAYE tax credits. Rental, there's no deducted source. Dividend, interest is. They might have another 2,000 here, 2,000 here, but no tax deducted at source on rental, self-employment, gain on sale. So your total tax credits from 40 will be 29. Balance 11 you have to pay. That's your tax to pay position, 11,000. Now government gonna say that, hey, you're paying 11,000 this year, what about next year? It's highly likely you might have the same amount next year too. So they will say that times by 5% or 10%, divide it into 3 installments and give it to me next year. This is how it's going to look. Very quickly, it's the last thing. I often get asked people about the overseas income. People get too confused about the overseas income and how that's going to work. Very simple concept. In the previous slide, what I just showed you, that type of income, overseas income is just added up here. That's all. Overseas income will also go here. So as a worldwide income being taxable in one tax jurisdiction, so more likely any income that you receive in any part of the world is also going to be taxable in your home country, and if it is, you have to report that there, and any tax paid at source will be taken off from there too. If you like this video, subscribe to my channel, like and share the video. Have any question, please ask in the comment box. Thank you.